Welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a financial mediator and business valuation expert in St. Louis, Missouri. In this episode, we're actually talking about exit strategy, but we're also kind of getting into the company, and we're talking about how to prepare management for sale and to create a business over time worth buying with Tejal Shah, and she's in Houston with Congruent Advisory Services. And the reality is exit planning is a process, not an event. And that is one of the brilliant things that we have already talked about without even starting the recording. And it really kind of started off as me talking about a client that I recently saw that has, a $10 million business in a very, I would say, a construction related business. And they were saying, how should I sell my, should I sell my company? I mean, this is a very casual conversation across lunch kind of situation. Like, hey, I'm thinking about it. And I said to them, you could do a lot of things to get ready for it. But the best thing is if somebody calls or knocks on the door that you're ready to have that conversation. But realistically, what do you think about, somebody comes to you like that and says, I'm thinking about someday and everything's a mess and everything is, chaotic, and maybe they keep their books on Excel and maybe they, don't have any marketing, but they're running a great cash flowing business. And maybe they're 10 years before they could sell, but they're at their highest revenue. And so it's a great time, but not. So welcome, Tejal. How are you?
I'm good. Thank you. Thank you, Melissa. Great introduction. I love the scenario that you posed. It's something like that would be almost kind of a dream for a consultant like me, where it would be like, oh, sure. It's almost like where to start. There are so many things that one could do. But the best would be that just please know exit planning is a process, it's not an event. If you want to maximize value in your business, ensure that you've got the financial infrastructure in place, you've got your people teed up in the sense that they are truly the assets which are helping you generate value. Note it is the owner or the senior management or the executive management who sets the strategy, but it is the middle management that executes the strategy. And any strategy, however phenomenal it may be, if it is not executed right, it's going to get diluted a little bit. The business value is diluted. So ensuring that your middle management comes along or your management comes along with the owner, as they are prepare I would say preparing the strategy, planning for the strategy, they need to have as good an idea, to ensure how the strategy needs to be executed, because that is where true value generation takes place at the management execution level.
Well, and I think that for the most part, we've built a capitalistic society that is used to utilizing people to make lots of money, especially lots of money whenever they sell the company. And the people are who's doing it. So let's go back to my business owner. Now, he's in construction, he's doing a great job. And I'm like, well, what are your people? Oh, I just got 2 or 3 or 4 people. And I was like, wow, you're doing a lot for 2 or 3 or 4 people. And he's like, oh, well, that's like management. He's like, we have like 8 teams, 10 teams going out and doing. And I was like, hold on, sir. That is a lot. And so if we even dial this back around people and the people involved, and in this current economic system, people are so valuable to how, you're buying businesses. And so if we start with the main person in this business transaction, it's the owner. And so when I'm talking to him or her or anybody, multiple owners even, what does the role of the owner have in the exit strategy and the transparency or discussion around it?
Which is I'll take this back to exit planning is a process, not an event. Yes, the owner would like to monetize what he or she has built or what they have built, in ensuring that they create the right infrastructure which is valuable to the buyer. People are an essential part of it. It is not just, to example, your construction. It is not just about how phenomenal or how well the project is going. Is the project making money? It is also ensuring, are your people trained well enough to see that there is no value leakage? If they're struggling to finish a job, that's value leakage. If they've not got the materials on time, that's value leakage. If they have to go back and redo some stuff, that's value leakage. So it's important to see to it that your people are trained, that your people are aware of what it is, to what your targets are as far as project completion is concerned. What are the margins that you want to make? And I would say that at middle management, I'm not talking about, the person who's actually building the structure, because they just might be temp or they might be per hour people. But your middle management people who are actually getting the process executed, they need to be aware as to how that project is going. Because that efficiency in operations is going to be reflected in your financials. Your project is going to come in on time. It is going to end up making money. It is going to be a net positive project for you instead of a net negative or break even. People don't do business to break even. People do business to make money.
Right.
So the point is to see to it that your middle management is trained. The middle management is aware to see the steps that they are taking on the field, how they impact the financials or how they impact money. If you have a middle management, or I'll say management instead of middle management, if you have management that is truly aware of the steps that I'm taking on the field, here is how they're going to translate into money. Now you have an asset that has actually built a bridge from what is actually happening in your company to what is reflected in the financials about your company. And that bridge, if they are aware of it, again, they can walk that bridge. They are an invaluable asset, not only to you, but to the buyer who's going to go ahead and buy your company someday.
Right.
Imagine knowing that entire path, from operations to financials. Okay, here is going to be the impact of it. Here is where value is being lost because of a delay, because of a substandard material, because of an untrained worker. If they're aware of this, and I speak from construction because that's the example that we took, but that applies to all businesses. The steps that are being taken, the operations, the manner in which the operations is being performed, the impact of that, what it is there on your financials, be it monthly, be it weekly, be it annually. It depends upon how much you all are tracking your, financials. Are you doing things on a monthly basis? Are you looking at things on a weekly basis? There are some, because, in construction, it could be weekly, right? Because you've got to pay cash is king,
Right.
And so to ensure that we're, the management is aware of the entire path, that is just, that's an asset that you've created not only for yourself, but an asset that you've created for the buyer too. Where, Melissa, I would say it also helps is 75% of the businesses that want to go out there and get themselves sold don't actually get sold. It's not easy, right?
Mm-hmm.
In this, regardless of whether the business is sold or not, you've still created a business which is generating tremendous amount of value, not just from a financial perspective, but from an intangible human resources perspective, from a capability perspective.
Mm-hmm.
That person is going to multiply their effectiveness and yield you more value while they are with you and also while they're not with you. Even if they do go ahead and step out, they're going to step out with the feeling of, you know what, tremendous value generated. I learned a lot. I received a lot. Should they go somewhere else, they'll think of you.
Right. But I think that some of the things that you're addressing in here have to do with companies that are really moving from like $1 million revenue level to a $10 million revenue level. You have to start having these conversations. You have to start, having outside parties work on your financials and develop your financials. You have to start being transparent with your financial situation with your employees. Like, let's be honest. How often do we see the business owner of small businesses under 15 million in revenue having these active discussions with management about the financial reality? Isn't there kind of like a certain threshold that you see when they start engaging the team in some aspect, or is it that they need to start doing that?
So that would depend upon the objective of the owner. What is it that he wants to do? And I am of the opinion that information is power. Disseminating information is more power, because now there are a couple of things which come into play as you disseminate information amongst your people, amongst your management. One is trust. They know that they are trusted. When people are trusted, they tend to bring more of themselves to the table. Number two is when they are actually able to see the financial impact of truly what they do, that is when the connection happens. Here is why this project is not yielding as much, or here is why this project did better.
Mm-hmm.
Right? Because every project manager, every manager that they actually know as they are executing as to what is happening on that. If they're able to tie it to the financials, and if they're able to have an intelligent and a knowledgeable conversation with the owner, guess what? It's a win-win for all.
Mm-hmm. Well, and it's interesting because like one of the things that, we're going to talk about is the role of management in executing an exit strategy, which to me means that we have to go back to the beginning and say, okay, at what level of detail are you communicating people's actual interactions? And quite frankly, if you start talking about an exit strategy with your management, why would you, I would think you would completely offer people some sort of benefit when it does sell, so that they are part of it and they understand how they are a part of it. But as I've done this for a couple decades, I know you have a ton of experience. I'm just thinking why wouldn't we just say to people, hey, we're thinking about exiting in the next few years and you're going to get a cut from it too. So let's all do this together. Why are we not doing that normally?
Yeah, so I've seen it go both ways, Melissa. I've seen it create a level of unrest wherein oh my God, we're going to be sold. What happens to me? Or it's a question of if there is trust with the owner, if there's great relationships with the owner, then, and that's why I say it's a process. This is not an event. If you go ahead and say we're thinking about selling, what happens is it's an event. Oh, we're going to be sold in the next 1 to 2 years.
Okay. Yeah.
But if it's a process where you've kind of seen to it that your people are also trained, they are aware, they know of the value which is being generated in the business, the owner has invested in them, in their training, in their knowledge, in their preparedness. Now the level of security for the person is a lot more, because they know, if not here, somewhere else, number one. Number two, they're already aware of how they are generating value in the business. When you're aware of how you're generating value in the business, and if you can articulate that to the buyer, buyer wants to see to it that the business that they are buying continues to generate money,
Yeah.
so they are more secure and they're more valuable to the buyer. Would you
Well,
agree? I mean, yeah.
absolutely. But I think that you have a traditional mindset that is like, well, if we tell the employees how they're creating value, they're going to press us and want more money. Like, you have a lot of old school mentalities that are
Yeah.
still in play, that I'm the boss, and if I sell, I'm going to sell. And these are strategies that are being employed in smaller family held businesses where the people in management or around are very well known, but there's this hesitation. And so I think that,
Yes. Yeah.
framing it around exit planning or
Yeah.
like strategic planning sounds a lot better. Like saying, here are some options that could happen in the future. We could grow, sell, buy, sounds a lot better. And maybe that's how you start.
Maybe that's how, yeah. Well, number one, maybe that's how you sell it. Number two, how you pitch it, to the management. Or it could also be where you don't say anything because it's your business.
Yeah.
You want to kind of go ahead and uh, 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 run it the way you want. The intent is whether you let your management or your people know or not. The intent is to have that focus to see to it that you're making your employees valuable by
Mhm.
seeing to it that you start having the discussions as to where you start building a bridge between financials to operation, be it on a project basis, be it on an ongoing basis, be it on every 15 days you catch up, every day you catch up. And a point comes where at the end of the month you're talking about, hey, what happened to this particular project? We were delayed on that. We're seeing that the margins are coming down. When you start having operations to finance conversations, it does click. It does not have to be, I'm preparing for a sale. No. You could make your employee valuable by not bringing sale into the picture at all.
Right, right.
It could just be start having these conversations so that your people become more aware of, all right, here is how I operate the project or how I manage the project. Here it is how it is impacting. Here is it is how it is impacting the financials, or how money is being impacted, how value is being impacted. Once they build that bridge, it is actually a more knowledgeable and a more informed conversation. And that it's not just about finance. Say you have a few vendors, maybe one of your vendors is tricky, maybe you have a single sourcing risk with the vendor. Start having that conversation with your owner. Hey, you know what, this person's kind of giving us issues. It's they've given material, the order is not complete, they don't give us complete material quality. Okay, well, you know what, let's look for someone else. Because here is how it's impacting the project margin, the project timeline. So when you start having those conversations, automatically it is clicking. It may not click once. Let me tell you, by the time the second or the third project it comes into play, your manager is going to come and tell you, here is what is happening, it's eating
Right.
into our margin. Once you start speaking, because people catch on pretty fast as to, okay, we are looking at it from a margin perspective, we are looking at it from an efficiency perspective, we're looking at it from, and then they'll start speaking the language. As goes the owner, so as goes the firm, as goes the firm, so goes the owner, as goes the owner, so goes the firm.
Right, right.
Yeah.
Well, and I think that that's part of why focusing on middle management or management in general is really important in any exit strategy, because the first thing any buyer says, I don't care what company it is, I don't care how much, is there a good management team in place?
Yeah.
Are they coming with it?
Yes.
Right? Because sometimes they want the owner, but like they know that the owner is going to be a short-term exit. Like they know they are only going to be able to keep the owner for like 6 months, 3 years, whatever the term is.
Yeah.
But the management is what the buyer is asking almost immediately before even seeing numbers.
Yeah.
And so if we table the conversation and we say, you don't need to tell them that you're selling or not. Now, what is the conversation that I'm having with middle management, and how am I getting them to this? Because I totally agree. They need to know how it affects the bottom line, maybe because they get part of the bottom line. Again, I think we have to start sharing the profitability in these teams so that they have the motivation and the benefit to make it happen. But what else are we talking to them about if they are part of our biggest commodity, our biggest asset, our biggest strategic, positivity in a transaction?
So one would be just the fact of preparing the business is what I would say. Remember, as a owner, your mindset and strategy is completely different than your management is going to follow the strategy that you put in place. So it could be a strategic planning thing, it could be an exit planning thing. Exit planning would come in at the very back end. The other thing also would be, as you are stepping out, as far to communicate value for your business, not only it is you that you're doing it, but even your people are communicating the same value.
Mm-hmm.
Story is going to be cohesive. Would you agree? It's not just, because they are all also listening to the same thing or similar things. They'll say, oh, you know what, we've been executing 5 projects, we've got some pretty big contracts. People have those coffee bar conversations, or bar conversation. They'll go, oh, how's it going? Oh, well, we're doing fine, we got a big contract, we got this. People do talk. I mean, this is just casual talk. Work is a very integral part of people's lives, and it also forms a very big part of their security, knowing that their work is going to continue, they are doing well, the company is doing well. Imagine having a conversation in a bar with someone, and I have seen this happen, and that guy says, oh, that's pretty interesting. He goes and tells his owner, oh, you know what, I was talking to somebody in construction, I was talking to this siding guy, they seem to be doing well, they have work lined up, their backlog is pretty hefty. I think we were always thinking of expanding into this geographic area, maybe we should talk to them. It happens, it does happen. And people in especially in this 10 million, 12 million, $5 million, I mean, people, it's a very cohesive set of people. The people know. I mean, I'll tell you, I worked with one of the waste companies. The owner knew the grandchild's name. I mean, literally, what school they went to, what was the big function that they participated. It's a very cohesive set of people where people know they're very intertwined in people's lives. And knowing that you're so intertwined in people's lives, why not share with them some information? I'm not saying all, some information which becomes more meaningful to your manager, where they can talk intelligently and cohesively about operations as well as the money part of it.
Well, and I think transparency is key as we go in to talk about more of what value buyers put into it. But transparency is a very interesting trust builder. And I think if you have a company that's under 15 million in revenue, I'm going to just make a blanket statement that you don't have enough employees to prevent talking. And if you're getting up in age, everybody's already talking about what's going to happen. What's like, they know before anything else. If you think that your employees don't know what's going on, you're crazy. So the more you get ahead of that narrative and you don't get found out, because then you look like the person that kept some stuff back. Even if you don't care, when the buyers go to interview management, they're going to ask questions.
They are, yes, they are. And at that point of time, if they hear a story that is similar or cohesive, imagine the amount of trust that's generated. It's not scripted. Everybody's telling their own thoughts, and if they're seeing that it's the same thread running, all of a sudden your business is much, much more valuable, because now they've talked to grassroots level people. And they've taken their thoughts. And so that's why I would say that sharing Sharing information, I would say, is power. Hoarding information is not. People sometimes say, oh, we don't need to let people know. Well, don't let them know everything, but be strategic about what you do want to share.
Yeah. You're
You know?
creating the narrative that they tell the world, themselves, their spouses, and things like that. And, you know, people are one piece of a business. You can't, you know, I tell business owners, you can't make a buyer keep your people. You can't guarantee what's going to happen. Even if somebody tells you they're going to keep everyone, the day this closes, they could fire everything.
They could,
Fire everybody. They could get rid of everything. But what are some of the key factors that you think are currently making businesses attractive to buyers? Because I don't, you know, like we've talked about revenue, we talk about people. Buyers are looking at a lot more than just that, and sometimes doing deals that are based on a lot more than that. So what are some other things that you recommend business owners do to be more attractive and be more valuable?
Right. I would also see to it that they have almost the right infrastructure in place, the financial infrastructure in place. You know, the financial infrastructure is almost telling the same story that your operations is. That you have processes where people know as to here is how things are managed. You know, here is how, and have structured, consistent processes which are implemented across projects. I'm talking about your construction example over here. You know, I mean, that there are standard operating practices, there are standard procedures where, you know, and the other thing that I would say is the operations person knows the impact he has on the cross-functional collaboration. You know, the purchasing person knows what the operating person is doing. The operating person knows what the financial person needs. The financial person knows what he or she needs to ask, you know, your salespeople, your purchasing people, your operations people, your safety people, you know, all of them, so that they know what the cross-functional impact of their work is on other people.
Yeah.
If that is known, it automatically becomes a very valuable business, you know, because imagine knowing that your operation person knows, you know, what he's trying to achieve or what's coming down the pipeline because the salesperson has talked to him. You know, imagine your purchase person knows what your operations person is going to need because of the amount of projects which are coming down the pipeline. You know, imagine knowing the financial people will say, hey, you know what, why is this spent so less? I know the purchasing guy went ahead and did this. I know this project has actually taken a lot more material. I mean, so why are we not seeing it? Imagine the value that is generated, and imagine the risks that are mitigated in the financials, and the risk that is mitigated for the owner, because now the person truly knows what is happening in the business.
Well, and I think that operationally having management aligned, it just makes for a more efficient process. I think the other, another thing that business owners have to consider is you have to start cleaning up your books. You have to start cleaning up this process. So if you're communicating with employees and you're like, well, I don't know what my profit is because I'm running everything through it.
Yeah.
You know, we've had significant conversations with SBA lenders. We've had significant conversations with banks. They want to see your tax return. They want to see your financials, and they don't want to adjust it by $1 million.
Yeah, they don't.
And you know, or buyers are coming in and doing quality of earnings reviews, and they're saying, you know, your cash flow really isn't what you said it is. EBITDA is. You know, like these are also things that I think the owner, you know, has to start taking control of. Like, yes, we've run the business a certain way because it's been family held and this has been great and we've made so much money. But at some point, you need to plan for this exit, because you're going to exit. We talked to somebody and they're like, you're going to exit. You're going to die. You're going to get a health issue, or you're just going to want to do something else. And you want to do it before the business starts to go look down because then you might have to exit and lose money.
Yeah.
So the owner, what are they doing at this point to increase the value?
Yeah. So I would say, on an overarching basis, the principle behind it is to be proactive and not reactive. Because if you're reacting, you're automatically diluting value a little bit, but to proactively go about ensuring that the financial are in order. Why? Because money is the language of business. Ultimately, everything gets translated into money. That is one tangible thing where people are actually able to say, all right, I see you are day in and day out spending 2.5 million, and you are day in and day out generating 4 million. That's tangible, and they want to see that. All right, that's what I heard you say. Is this what I'm seeing on your books? And that is what they will end up taking. And that is why financials became important. Just so that that is what translates your operations into the value that you say your business has. And that is why looking at financials is important. Whether it is cash basis financials, whether it is accrual basis financials, that's different. But regardless of whichever way you go looking at it, one needs to ensure that your financials are speaking or conveying the same story that your operations is telling. Because if it is not, and if there is a disconnect, let's go back to the grassroots level and let's fix it. Because your financials need to speak that story. And that's a bigger risk, because the risk, people, the risk in financials is not what is wrong, is accounted for wrong in the business. No, the risk in financials is what should be there but is not there. That is the risk. Because if something is off, one can fix it. Oh, this was not recorded right. Oh, we are not showing this right. Okay, it's a known risk. It's a matter of fixing it. But imagine something is just not there in the financials and it should be. That's a bigger risk. Knowing what you don't know is a bigger risk. The point is to ensure that you have things in place to see to it that you are tracking things and things are being captured in the financials.
Yeah, I mean, I don't, I do hundreds of valuations, and and I've done thousands over the course of time. And I will tell you that, half of the time, and these are very large companies, these could be up to 100 million in revenue. And now when you're getting to the 50 to the 100 million, they definitely have CFOs and people in play, and you have management in line. But when you're looking at these smaller ones and you don't have all of these pieces because you just can't afford it or whatever, you have to figure out how to grow your structure, how to build your efficiencies. I think giving some ownership to middle management, to like, hey, you're the purchasing person. How can you decrease our expenses? Hey, you're the social media, we're buying social media. How can you do it? You have to give some of that back as the owner to get them involved. But I'm just trying to be really clear that in that space between 1 million and 10 million is where these growing pains happen. And you have to start shifting, because really, a lot of companies even want to buy $1 million of EBITDA, right? They want at least some sort of, most people are buying companies at larger levels, because at the smaller level, you might not make as much. Sometimes you might be like, well, why don't I just stay here and continue instead of going somewhere else? What other things should an owner be conscious of in how they operate?
I would say safety risks. It's important that the business is safe. That there are not too many violations, OSHA violations, operating violations, seeing to it that regulatorily you have things in place. Say you are a plumbing business or you're an electrical business. How many licensed electricians do you have? Are you keeping up to date with the licenses? Are you ensuring? Because all of these, When things are going well, that's great. Things just need to be, there needs to be a little blip, and things can snowball very quickly. So it's important that you have your regulatory aspects taken care of. You are compliant with the laws, you're having your contracts are a-okay. You've gone ahead and ensured that if there are any contracts that you have with your customers, you're taking care of those. You're seeing to it that they are being managed properly. And Melissa, just a minute ago you talked about the 1 to 10 million and then the 50 million and above. The nature, the risks remain. It is just the nature and the magnitude of it that changes. It is the oversight, because there, for a $50 million business, you're actually relying more on your management, right? Because you cannot know everything that is happening. You're actually relying more on your management to let you come and tell you. So it's not a pull mechanism, right? It's actually a push where they're coming and giving you information. Not everything is there with you in your mind. So I would say that there, the function of the middle management is actually a lot more critical and important. They're training, how much they know, how cross-functionally cohesive they are, and whether what is happening in the company, how it is all being captured in the financials. There it actually becomes more critical because the magnitude of it is more.
Oh, absolutely. And I think that you bring up a good point, because in all of this, you have to start doing something different. And if you want to be poised to sell, most business owners are like, oh my gosh, I do something so unique, like I'm the business and whatever. At a smaller, under $10 million company, if a buyer sees that the owner is everything, that does not increase the value of the company. Now, most business owners say that they are everything. And usually when they're getting divorced, they say the business is worth nothing without them. That's not true, but buyers will we'll sit back and say, okay, could I make that same $5 million off of Melissa giving business valuations? Because we don't have Melissa, so you have to balance that with, you are actually building up your management team, not only to be successful, which should be your primary goal, but that when you go to sell, if it is all reliant upon you, that's not going to bode well for your transaction. So what role does middle management play in increasing the value of the business and during this, process of growth?
Yeah. So one line answer, having a management team in place makes it more attractive, because it's not seller dependent, and all of your brain power is not the seller.
Right.
Your brain power is disseminated amongst the management, and that brain power is then coming to you. So it automatically so it becomes a little bit more attractive. So somebody could be doing 10 million, and if the brain power is all just the owner, and the middle management is just executing it, very quickly the buyer is going to know that it's the owner who's doing all of that. Right? Very quickly, because they'll talk to the middle management. They'll say, oh, well, why this, how this? They'll go, what, the owner said so, or imagine the conversation where, oh, here is why we went about doing this. We wanted to go ahead and expand geographically, and that is why we made inroads. And imagine a management team talking about that versus the owner said so. And we both know that those businesses are there where everything is in the owner's mind, and there are people who are just executing it. Regardless of how well it is executed, that business is a little less attractive than, the business where the management is more aware and management is more informed of the why the decision was taken instead of how the decision was taken.
So I have one unique question then for you, because we will see a lot of family held businesses and they become very successful. They could be based on real estate. They could be based on operations and investments, but let's say they get up to the 50 to 100, $50 to $100 million in revenue, right? We still will see some critical management be family members.
Yeah.
And if you have like president, CEO, CFO, that are all family, that really in a transaction will potentially not stay long.
Yeah.
Do you go into that corporation and have recommendations to, like, how do you deal with something?
Yeah. So, the name of my business, Congruent Advisory, you know, um, I will go in and tell the business what they need to hear rather than what they want to hear,
Yeah.
and I'll go ahead and share my thoughts with them. Sometimes the thoughts don't resonate, and it's okay if they don't. I mean, I'm doing my job. I'm going ahead and letting them know what needs to be done. And I'll say, 9 times out of 10, if you've gone ahead and shared why you are sharing what you are sharing and the impact it can have, even if they're not on board, they will actually listen. They will listen, and I'll say, okay, why don't we do this? Why don't we go about bringing somebody on board? Because if it's 4 of your family members, if y'all are all going to monetize this and step away, think of it from a buyer's perspective. What value is he getting?
Mm-hmm.
Even from a transition perspective, he needs some legacy knowledge, right?
Mm-hmm.
He needs it.
Yeah.
Or you go ahead and say, you know what, y'all will stick around for a year and a half. But we all know that once it is sold, the owner is not that vested, right? So start putting people in place, that can carry on the work and see to it that the business continues to be more valuable. Or it could be that there are companies who are looking for such, where they want to take the whole thing over. They don't want the legacy owners. Then they'll start operating the way exactly that they want to. Then those businesses are attractive, when no, the entire senior management is family. They're going to be done, they're going to move out and we will take over this entire operation. Even then, I would say from a legacy perspective, some sort of continuity is appreciated and helpful. But then that's a known risk that the buyer is willing to take.
Mm-hmm. Mm-hmm.
And they've already considered that in their mind as to what are the risks if none of these are. So
yeah, and I think it contributes to culture. I think that family businesses just have to be aware, or even business owners have to be aware that buyers are not going to fall for your baloney. And just because people around you, if you've surrounded yourself with a management team of yes people and you really don't have a good idea, the process of going through a sale is not going to be, having this conversation multiple years before you decide to do anything allows you time to clean up some things and to get everything ready. But I want to talk a little bit about due diligence, because some of the reasons why we plan and prepare is so that when you get to this concept called due diligence, that you don't basically break your deal because they find all of the things that you kind of BS'd about. So how can companies ensure that some of their middle management is effective during the due diligence process? Because that is when we're starting to get, maybe you can even just give us an idea of what to expect in due diligence. Like, what the heck is it even, right?
Yeah. So couple of aspects, right? There's operational due diligence, there is financial due diligence, there is legal due diligence, there is regulatory due diligence, right? I mean, in the sense, when I mean legal, I mean contracts and things and stuff. Regulatory, OSHA, have you been compliant with all of your, laws, things as such, So if we break up the due diligence into those couple of buckets, now financial due diligence is the CFO and the team who are going to go ahead and take a look at it. And actually, our firm goes in when a business wants to get sold, they will go in and they will prepare for it, because people will want to look at the past 3 years, and if they see a lot of inconsistencies, they go a little further out too. Let me just tell you that. But 3 years is what we've normally seen, and okay, what are the financials saying? All right. Oh, we saw a big spike in revenue. What happened? All right. Did we have more contracts? Was there one big contract? Is there concentration of risk? Is most of the money coming from 3 customers or 5 customers? Is one particular geography? So basically, what we do is we look at all aspects of the transaction, all aspects of the business, and then we see, is this a composite narrative, and is the narrative, for lack of a better word, hanging together?
Mm,
Is it making sense?
mm,
And while the due diligence, while we are preparing, while the seller is preparing for the due diligence, there are ongoing conversations with the management also. Remember, it's not that they need to know. It's about, hey, you know what? We're just trying to find out what happened. Was it, I see these 3 customers, they had a big spike. What was happening? We generated a lot more revenue. And then what happened? 9 times out of 10, the operations person is going to know why that happened. What happened? The point is to start slowly feeding these stories and ensuring that they have the awareness of what had happened in the business in the past 3 years. It could happen as to a business process consultant is coming into play. It could be we are streamlining our processes. It could be we're trying to see to it that cross-functionally things are hanging together. There could be multiple ways. And that's where I would say a skill of an advisor comes into play. That's where we come into play. We ensure that management becomes informed, or they almost remember or re-energize their neurons to say, oh yeah, here is what happened in the past 2-3 years. And it's also then ensuring that the narrative is fed. The narrative is discussed. I think fed may not be the appropriate word. The narrative is discussed, and that is how cross-functionally a cohesive picture would come into play. That is how normally what I have done. What
yeah.
does legal say? What does regulatory say? If we have had any violations in the past, and I have seen that,
Right.
I mean, the point is to know that it is there, and also then to go ahead and say how you've solved it, because you can't undo the past. But what you can say is, oh yeah, here is what had happened, and here is what we've done to solve it. Here are the mitigating steps in place since then, and it hasn't happened again. And here is how we ensure that it doesn't happen again. And that's why preparing for due diligence is as important. Why? Just so that if there are any skeletons in the closet, we are aware of it, and we have the narrative to support why they happened, what we have done about it, and why that risk is mitigated to a significant extent.
Yes. And I love that you use skeletons in the closet, because I like to use the analogy, like we pull the skeletons out of the closet, we dress them up, we get them ready for the party, but we're going to introduce them at the beginning.
Yeah.
And, it's interesting because a lot of times when we do business valuations, we'll have owners that, and I think this was the thought that I didn't finish earlier, but we'll have owners that look at their 5-year past and they have no clue that their volatility in their financials. And a lot of times when we're doing the business valuation, we're asking them questions like, well, do you have contracts with your employees? Oh yeah. Well, where are they? I don't know. Do you have this contract with your major vendor? Oh yeah. Well, where is it? Where is that contract? So in some aspects, I think to get prepared early for selling eventually is collecting all of that data and pulling a due diligence list. Like we tell people before they go to market, or if they're going to go to market, have your due diligence prepared first, so that you know what sort of drama could happen. And maybe you have to pause and not go to market for another 6 months or a year, because more often than not, I will see somebody and I will be like, you are not ready and your financials are garbage. And if somebody comes in and looks at this, what are you selling? What are you selling? Right.
And the other thing is, say you've gone ahead and I've seen this, I'll tell you this, you've gone ahead, you have an interested buyer, you've kind of come up with a value too. Okay. maybe they didn't put in that much effort that was needed for the due diligence, because sometimes we come in pretty late in the game.
Yeah.
Everything that is found brings them to the table. Knock, 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 knock. Things are being knocked down. Why? Because it was found as a part of the due diligence by the buyer and not what was conveyed by the seller.
Right.
Well, it's the same thing. If the seller had conveyed it, here is what was there, here is how we had treated it, and here is what we're going to do about it. It's a very different story. It's a very, very different, because it talks about the pulse that you have of your business in your hand.
And the simple analogy is like, I have a Ferrari and it's beautiful and it's this age and it has this many miles and it's got this little scratch, and they say, okay, I'll pay you $100,000 for it. And then they come to test drive it and it doesn't run.
Yeah.
And you're like, oh, well, I'm sorry I didn't mention that, but like, yeah, I mean, it's not a big deal. And they're like, hold on, I would have only paid half of that if I knew it didn't run. That's exactly what happens in your deal. So now you have a buyer and you're supposed to close in 30 days. Right. And this has been a long process. So this is like at the end of 12 months and we got 30 days. And this buyer's like, yeah, I know that I said I'd pay that amount, but I'm going to reduce it. You get into a situation as a seller where you're almost having to say, okay,
yeah,
because you're 30 days from close. You've already booked the vacation. You've already told everybody. You've already gone, like if you're prepared, those conversations, like there's so much that you can avoid in the transaction that you may not think, like you may think that everybody's just talking about this, but the way things break in transactions are very preventable.
Yeah.
They're very preventable. Like even one of my clients said, hey, my brother runs a similar business. Like, do you think that's going to be a problem? Yes, sir. I do think that's going to be a problem. Or we need to disclose it. Because if they start Googling and they find the same name and the same plumber and the same whatever, that's not going to work out very well. But I want also to talk a little bit about you, your company, how people can find out more. Like people like us usually offer to talk to other business owners or professionals. And to see if it's a good fit or to see what we do. But tell us more about like how you help businesses and how you work with them.
Yeah. Melissa, first, this conversation was a joy. I mean, it just flowed. It was good. I hope you felt the same too. It just
absolutely.
We were vibing, to use
the younger generation.
Yeah, exactly. So we're a financial advisory firm. We work in a couple of areas. We work in M&A. We also help companies prepare, go public, and we also help startups with reference to establishing financial structure for them. Our conversation was primarily focused on M&A, so I'll go ahead and stick to that. So we go in and we help companies prepare for sale. And we live by the maxim that exit planning is a process. It's not an event. The best thing a business can do is ensure that their financial, operational, legal infrastructure is cohesive and in place so that they are able to capitalize on the opportunity that knocks on the door. It's not about reacting when somebody's interested in trying to put those things in place. It is about being prepared. We do this from an advisory perspective also, as in, say $1 to $5 million, they don't want to go ahead and spend. We'll go ahead and say, we'll take a look. We'll go ahead and say, here are the things that you need to put in place. Here are the things that we see are, missing. And just because of having been in the business, having been in this field, we're able to grasp some immediates that need to be taken care of, and Or it could be that people could go ahead and say, okay, can we guys have you on a retainer? It could be that, and we would go about going on and we would go ahead and work with them and help them put the infrastructure in place so that they are prepared. Remember, 75, we talked about this earlier, 75% of the businesses who want to get sold don't. Guess what? Even if you're not sold, you have a very valuable and a more cohesive business, which can run more efficiently and better and generate more value for you.
Yeah.
This process is anyway going to help you.
Yeah. And even if they come and knock on the door, the thing is, if that knock comes at the door and you're not ready, it's going to get you ready. Like, that's going to be your impetus to like do all these things. But that buyer is probably going to be gone by the time you get it done, because it might take you 6 to 12 months to do those things. Because again, if you are at the height of your career and you're doing so good in business, I would venture to say you don't have the time to go sell your company. And selling your company is a part-time job. Like, you're going to have, you're going to have to be a part of it. It's emotional. It's things like that. So the knock at the door may be beautiful, but if you don't get prepared for it, and really people think that calling the investment banker or the broker is like, oh, here you go sell the company for me. And that is not at all true. It's like staging the house. Like, you don't just call somebody and say, go, like sell our house with our whole house a mess, right? You want to stage it. You want to prep it. You want to get ready for it. And that is what you're saying could benefit you now as well as into the future. And I think that that's absolutely, you should work with really strategic consultants like you that have the depth of knowledge in accounting, has the depth of knowledge in finance, because when it comes right down to it, if you can't really adequately say to somebody, they should hand you a $5 million check because you have so many risks involved, then you need to mitigate the risks.
Yeah. And also, when the buyer knocks on the door, seeing how prepared you are, he's going to attribute appropriate value to you.
Absolutely.
It's not going to be, oh, here's 5 million. No, everything is exactly as the buyer anticipated. Sure, the value is 5.
Yeah.
But if they're finding some things, guess what? Now it is 475. Now it is, 450. Now it is 425. Now it is, it keeps on whittling down.
Or take it even one step further. They knock on the door and they see how disorganized you are, but they see you interested, right? You're like, oh yeah, let's have a conversation. Guess what? They start to see you disorganized. They are going to negotiate against you well. And they're going to push you down because they know that you are not prepared. And if you go into the conversation without anybody, any advisor helping you with that conversation, if I were the buyer, I would be like, winner, I got this one, because you have an unsophisticated seller. So don't be the unsophisticated seller. Basically, like, you don't want to be that person, right?
And 9 times out of 10, say the buyer comes back to you, maybe with a specific point, an advisor is going to be able to at least guide you. Hey, here is how we can look at it. Here are some immediate responses. Here is how we can respond. Here is the time frame in which we can respond. Here is the information we have available. So it's going to be definitely a more informed response rather than a very reactive, which is.
Oh, I mean, we take it one step further and we will prep for the conversation with the business owner and say, okay, if you're the person that's going to go in and have this conversation and we're with you because you're not going to understand the financial language, we will literally be like, you lead it. These are the things we're going to talk about. Here's how we're going to direct it. And then at any point that you have no clue what that question is, you will turn to us and be like, Melissa, please answer that. Tejal, please answer that. And that is powerful. You can still, a lot of times a business owner is very much a part of the deal, but you also have to know what your strong points are. And even if you are a business owner that has negotiated so well your entire career, I'm going to guarantee you a financial advisor or a financial consultant can negotiate far better because when the numbers shift, they can shift with it.
Yeah.
And you have to be very nimble in those discussions or they're going to get one over on you, and not in a bad way, just like,
I mean, it's business. It's business. You know, people are trying to maximize the value for themselves, you know, and the onus is on both the buyer and the seller to maximize value for themselves.
Yeah, absolutely.
You know, so,
Absolutely.
yeah,
Well,
yeah.
this has been a joy. I love this. I'd love if we maybe continue the discussion and tackle some of these pieces, maybe even in a more tangible way with advice to some owners, because there's so many areas that I think we just barely touched on that are really big pieces, as well as we might need to talk more significantly about what people are looking at in due diligence, because I think that that could be a good area of topic. So we appreciate you and thank you for a wonderful episode, and we hope to see you again.
Thank you, Melissa. Thank you very much.